Welcome one rental at a time. I am Anna Kelly, and I'm super excited to be here with Casey Franchini today. We are filling in while Michael Zuber is out traveling and vacationing and having fun in Prague. And so today, what we're going to talk about a little bit is the hope framework and kind of what that tells us about recession. We get questions all the time on our channel. Are we having a recession? Are we not? Is it canceled like some in the, talking heads in the news say, or is it going to be really bad? And Michael and I talk a little bit about the economy every week. And so I wanted to talk to you a little bit about why I think we still are heading toward a recession, even though it's taking a long time to get here, and kind of some of the changes we're really seeing over the last week or so that's making me even stronger of the opinion that we are just on the cusp of a recession, either starting now or pretty quickly between now and the first quarter of 2024. It's hard to believe, Casey, that we are already heading into 2024.
I know.
But I think it's really important, to watch the data. And a lot of people get confused because all we talk about is CPI. Is inflation up or is inflation down? And if it's up, then we get scared and we think it's going to stay up for a really long time and rates are going to stay high and there's going to be no deals, right? And if we have a good inflation reading, meaning it's come down, everybody gets excited and says everything's going to be, fine. Inflation's coming down. We're going to have a soft landing. Eventually rates will kind of come down. And then you've got other people that say, oh my gosh, things have come down so much. We're going to have a really bad recession. The Fed will drop rates, but the economy is going to be really bad. So I want to give you a framework to kind of think through that you might not have heard before. I know Michael and I have talked about it briefly on the show before, but it's called the HOPE framework. And essentially what it does is it looks at past recessions and it says, how long does it take from the time that the Fed starts hiking interest rates to the time that those lag effects go through the economy and you start to see a recession? Because most recessions, Casey, are started when you have a booming economy and then the Fed starts to cool it off and they start raising rates and then eventually they go too far and we have a recession. And that's oversimplifying how economic cycles work, but essentially that's really what happens. And so over time, depending on what happened before the recession, how long it takes to get you there can vary significantly. And so the HOPE framework is something that's really very interesting as I've started to study it. And what it does is it looks at four things. And HOPE is obviously an acronym, but it's housing, it's orders, it's profits, and then it is employment. And typically what happens is these are leading indicators that tell you whether we're heading potentially into a recession and how long to kind of expect it to take to get there. And so housing is usually the first to lead an economic cycle, whether it's a leading up into an expansion or leading down into a contraction, i.e. ending in a recession. So housing has been in a housing recession pretty much all of this year. Again, that doesn't necessarily mean prices, although they are down in some markets and up in others, but it means that the pace of sales has slowed significantly, and we're seeing that. So housing has been in a recession. And the next thing is orders, and that's orders of things like supplies and the things that we need to keep our economy going. And those have already also been in recessionary territory for quite some time. And then the third leg that kind of comes down after, as these rates keep going up and the lags go through the economy, impacting the cost of goods, impacting the interest rates that companies pay to borrow in order to buy supply and things of that nature, it takes some time. But corporate profits, we started to see really start to come down a couple of quarters ago, and you see that those are starting to really continue. And we've had a huge uptick in corporate bankruptcies over the last month.
Yep.
And so it's important to see that these things have kind of happened. The thing that's taken the longest, that surprised a lot of people, is that we didn't see a rise of unemployment. And so employment has been really resilient. And really, typically, you don't have a recession until employment starts to tick down. But what surprises people, because we don't live through a lot of these recessions, Casey, right? People tend to forget because they don't happen all the time. They typically happen every 5 to 7 years, but we haven't really seen a deep recession since the great financial crisis 15 years ago. So people tend to kind of forget what they are. But what's interesting is most of the time, employment doesn't really tank until after we're in a recession. So what we're seeing though is just in the last couple of weeks, there's a key indicator, and basically the change in the unemployment rate is really an indicator that is pretty strong in telling you that a recession is on the immediate horizon. And when the change of the unemployment rate gets to about 10% change in where it was the prior quarter, you know that we're probably in a recession. And right now, as of this last month, and I actually saw this through Adam Taggart on Thoughtful Money, the change in unemployment is now up 7%. So it's not quite that 10%, but it's really close, where the unemployment numbers have ticked up. The number of temporary workers that usually really ramps up until you're heading into a recession that start to really decline has come down significantly. And what that's telling us is that employment's finally starting to roll over. We're starting to get some elevated unemployment. And that is telling us that a recession really is on the very, very near horizon. And so, the point of all of this is don't listen to the media and be kind of like so beholden to where is the inflation rate today, and making your decisions about investing based upon thinking that either rates are going to stay high forever where they are, or they're suddenly going to pivot and rates are going to come down, next month or in February or March, or thinking doom and gloom that it's a recession and it's going to be terrible and it's going to be here forever. You have to kind of watch these leading indicators to tell you where things are going, so that you can at least, although we don't have a crystal ball, and Michael and I thought we'd have a recession way earlier this year, and the lags have taken much, much longer this time to process through, it doesn't mean that the recession is canceled. So I want our viewers to really think about that framework as something to just kind of add to your knowledge base about where the economy may be heading. And the so what of that is, if we do have a recession, the good news is that means that inflation, at least for the immediate future, like in the next 18 months, 2 years, really does look like it's coming down, but that's going to drag the economy, and it's going to cause recession. And recession isn't necessarily a bad thing. It shouldn't be a really scary thing unless it's a financial crisis, right? A recession in and of itself is just kind of a softening in growth in the economy. But what it does is, if we have a recession, and I believe we're going to, the Fed eventually will cut rates again. And the Fed will cut rates sooner than this higher for longer that they've kind of said that they would do for a while. And so it could be good news for us that if we've got some loans that are at a higher rate, that rates may come down, maybe May, June timeframe, and we can start to refinance and lock in some of those lower rates on our existing portfolio. And it also gives us some assurances that we're not going to have to worry about, the rates staying where they are today indefinitely, especially for those of us like me who have commercial loans that are going to reset in a couple of years at new rates, whether they be higher or longer. So with that, I'll open it up kind of for questions or your thoughts on that case.
So do you have, you thinking rates maybe will go down next year? Any idea on what will be a rate that maybe we could reach? Everybody wants to know.
Yeah, it is really hard to say. I was looking at my notes really quick because I don't want to say his name incorrectly, but I do want to give credit to Michael Kantrowitz, which is who created the HOPE model. If y'all want to do a little bit more research and look there. This is a great debate within economists and those. I listen to a lot of people that have worked for the Fed in the past, or they've been on the FOMC in the past. And, part of the situation, part of the issue of why we have inflation, yes, some of it was COVID related, very, very clearly in terms of supply chain disruption. But a lot of it was really because the government overstimulated the economy, not only with really low interest rates, but with what we call helicopter money, right? All of us got money because of COVID into our banking accounts. And so we've lived in an era of relatively cheap money, and what economists call ZIRP, or the zero interest rate program, where the Fed funds rate was essentially at zero since COVID. But we've really been in kind of the zero bound, very low Fed interest rates since the great financial crisis in 2008. Every time the Fed started to kind of tick up rates a little bit, we'd have a tantrum of the markets and they'd cut again. And so, the question is, can the government afford to go back to what we call the zero bound, meaning a zero Fed funds rate?
Right.
Right now we're at 5.25, 5.50 Fed funds rate, which obviously leads to mortgage rates for owner occupied homes being up in close to the 8% range today. And so, do I think that they'll go back to the zero bound? I'll tell you the kind of my prediction. One is, if a recession is bad enough, they will temporarily try to get as low as they can without saying that they've totally capitulated and gone back to the zero bound. Because the zero bound, what it does is it basically gives us free money that's cheaper to borrow than what inflation is. And that creates huge asset bubbles and inflation, exactly what we just went through. So I don't think they want to go back to the zero bound if they can avoid it. I think Jerome Powell's going to say we need a new era of, basically good accommodative interest rates that aren't zero bound. So my guess is, if we have a recession that's fairly mild, they'll start to cut rates. Usually they don't do it until several months into a recession. So I'm thinking probably the earliest March or April. I think it's probably closer to May or June before they might cut rates. But if it's a fairly mild recession, or it's a rolling recession, which is really more of what I think we're going to have, I think that the Fed will start to slowly cut rates, not just one big fail swoop. But if it's deep, they could cut them pretty quickly. My guess is that in an effort not to go back to the zero bound and be accused of making the same mistake that they did for the last 15 years, that they land in a neutral rate of Fed funds rate somewhere in the 2 to 3% range. And that, still is about 3.5% less than where we are today. So if you get a 2.5%, Fed funds rate, you might be in the 5% mortgage rate range, something like that. So that's kind of what I see as the new normal, most likely, unless, again, we have a deeper financial crisis. If we do, I see them going right back to doing what they did before, going zero bound, taking us to super low interest rates, just enough to get the economy going. But if they start to see inflation tick up, which I've argued on this show many times with Michael, I think could start ticking up again, they have to keep those rates higher. So I'm going to say, in the short term, if things get bad, or God forbid we get more sucked into war, that interest rates could go very low very quickly. That's going to be our opportunity to pounce and refi everything we can again. And then I think that the longer term rates are probably going to be somewhere in a Fed funds rate of 2.5 to 3%. That would be my guess.
I think if interest rates do go down, like you're saying, dramatically for a short period of time, that is going to kill the housing market. I mean, it's already unaffordable. And that's just going to, there all the people sitting on the sidelines, all the investors, all the home buyers who haven't been buying because of interest rates. And then also a recession, their job might be in flux and they may not, feel confident enough to make the move and to buy. If rates go down, I mean, we're going to see another spring of 2022 with skyrocketing prices, multiple offers over asking, no contingencies, no inspections. I'm worried that we are moving closer and closer to a renter nation, and maybe home ownership will have been an American dream of the past. And maybe my kids, right? I have elementary and middle school kids. My kids will have a home, but they'll buy. But maybe my generation, I'm 41, maybe our kids won't be able to be homeowners. Like, maybe it'll be too expensive. I'm just seeing less and less people over time buy properties.
Yeah, I do think we are kind of heading toward a more secular trend, secular meaning a longer term trend, where we are becoming more of a renter nation for sure. I kind of temper that a little bit, just looking back at history, though. The one thing that I've noticed, and I've experienced this, on my own as well, is when you go through big shifts in an economic cycle, they seem to last a long time. And we tend to be afraid that it's always going to look like this, or it's always going to look like the last one, right? And so we think that that's kind of the framework that we think, okay, the future is going to look like the last one. But the reality is, over many, many years, I'm going to say 100 years. I'm not that old, but I've gone back and studied, since the Great Depression, at least least, what we see is that housing does remain fairly resilient. And as long as we continue to create jobs as a country, and that's a big, big important if we bring back production and we bring back manufacturing and we create really good jobs here in the United States to keep people employed, then I think that that's positive for home ownership over the long time. I think the United States can become resilient again. We're still the most resilient economy, compared to the rest of the world. So I do think that, once you come out of a recession, and let's hope that this one is mild, but let's say it's even a deep one, the reality is most people's psyches are pretty rocked for at least 2 to 3 years beyond that. I've done a little bit of research on consumer sentiment, post recession and during recovery periods. And one thing that worries me, kind of to your point, Casey, is that we have been through collectively as the US so many, like, oh my gosh, I haven't seen that coming. Oh my gosh, I didn't see that coming. So we had the great financial crisis, then everything seemed so great. Then we have COVID and that shut everybody down. And then we were really afraid, but then we got all the helicopter money, and then we were really excited, and then we have inflation, and then we're really scared again. And then things tend to get better, and then there's a war, and then there's another one. And so I think that what that does to our psyche is it creates so much uncertainty, things that are actually happening that we didn't think of, that it makes people definitely more fearful that what's going to be the next shoe to drop. Is it finally wise for me to stop spending so much money? Do I need to pull back? Do I need to not save up money for a house because I have racked up all this, credit card debt, or I have car payments? And so I think these kind of things we've experienced, to your point, I think are going to rock the psyche of most Americans. And if you look at consumer sentiment reports and you look at sentiment on home buying and even sentiment of home builders, that it's suddenly very quickly changed to all being very negative. I think you are going to have, over the next year or two, people that are going to be afraid, even if interest rates go down. I don't see it's going to be quite as much of a frenzy as it was last year, because I think now people are more afraid. And if we do have a recession, or this war, escalates, and we get more involved with the Israeli conflict or the Ukrainian conflict, I think that that's going to be enough for people to say, you know what? If I'm already in a low interest rate home and I really like my house, I'm not going to buy the carrot to be that move up buyer anymore, because now I'm more worried about the economy. I might take advantage to sell a house and downsize, so I think that single family home, that's kind of in that first time home buyer or downsize, standard, average median size home. I think that that's where you might still see some bidding wars and definitely increase in activity. But I think that that rush for the vacation rentals and the rush for the higher end homes and bigger homes, I don't think we're going to repeat that, because I think people are just too afraid. So I'm hopeful that rates coming down kind of normalizes real estate sales. I think that, again, if you have a recession, it generally pulls down on home values. But the question is, how much money is waiting in the sideline that still is willing now, in the midst of worrying about layoffs, willing to buy that new house as they were before? And I think you're going to see more people stay put than maybe some are afraid might happen. But I will say this: the longer I invest and the longer I've been doing this, I started off in private banking. I too, like your friend, your coworker, I had family members and good friends who were doing quite well, who lost their entire 401k or their jobs, like blindsided when companies fell. Southwestern Bell, MCI WorldCom, Enron. I was in Houston when all of that happened. And the older I get, the more I realize that I don't know, and that the economy is so complex that it's really difficult to understand how, the next recession, how people are going to react, because we've got these cumulative effects of, all these things that we've now seen in our lifetime. And the oh my goodness, red swan events just tend to keep accelerating. And I think that that's going to change things going forward. And so it's harder to just say, here's what happened in history, so this is what's going to happen.
It's always
So
different.
so I look at these things and I say, let's prepare for the worst. It could get bad, but if I prepare for the worst and I can say, this is what I'm afraid might happen, and if it does happen, it's okay, I'm going to be okay, then I can not be paralyzed with fear when everybody else is. And I can keep moving forward and making decisions and saying, these things could happen, but I've hedged it a little bit over here and mitigate the risk and then continue to take action, because wealth is really built when the economy is most uncertain and when the people are most afraid. And I know for me, I got really serious about real estate post 2008 when everyone said, Anna, you are an idiot. Like, you're already going to lose your job at AIG. You're taking your 401k. You're never supposed to touch that. Real estate's crashing. Why in the world are you going into real estate? And I was like, because everyone else is leaving it and there's lots of properties and no competition. So, you've got to have a little bit of guts that say, I can't figure it out. It might be a little scary, but I'm going to go for it anyway, because this is when the rubber meets the road and we create wealth while everybody else is afraid.
Exactly. So for everybody that's watching, we're going to be entering into a recession. It's going to be scary. There's wars. There's a lot of things going on. We have an election next year. Now's the time to get in and buy. And hey, if rates go down, you can refinance. You can get a new loan.
Yeah, as long as the deal meets your financial goals. And that's always the
for
thing
sure.
that I always caveat, right? Because
Yeah,
I
of
do
course.
I do feel like there are too many that say, you definitely can refi. I think we will be able to refi and closer now than what
Don't
before.
bank on
But
it.
what but yes, don't bank
Yeah.
on it. Say, does it cash flow to, if you need cash flow and that's your financial goal, more cash flow, don't do deals that don't cash flow. But if they do cash flow and then rates go down, then that's going to be gravy on the top, allowing you to pull out some equity and to be able to, create greater cash flow. So still only do really great deals. This is a time to be cautious. It's not the time to, have FOMO and think, I've got to do a deal today. I haven't bought anything in months. I look at deals all the time, but I haven't had anything good enough to make me say, I'm willing to do that and take the risk of this in particular. Although I look at deals almost every single day with very few days off. So do really great deals that make sense. And then realize that there is more likelihood that next year you'll be able to refinance at a lower rate than you are today.
Yeah, exactly. Make sure the property is cash flow, and 30-year fixed loans are the best bet. In my opinion, I mean, you never know what is going to happen, right? Who knows what really is going to happen in the future? We don't know. And if you're a safe investor like I am, and you don't want to lose your hard-earned money that you've been saving and working so hard for, do a solid deal. Make sure it's going to cash flow. Be in a good neighborhood. Um, don't count on saying I have to get a lower rate next year, or I'm going to do an ARM, or I'm going to do a DSCR loan with a prepayment penalty that's going to have a 5 or a 3-1 payment, and you're expecting to refinance next year. Just kind of remember some of those things and do really good deals. Make sure that they cash flow today, and if they cash flow even better tomorrow when you refinance, that's just the cherry on the top.
Absolutely. Yeah, I couldn't have said that better myself. I think, being really wise with the type of debt that you do is really important, especially in a changing economy. Because the other thing that'll happen is when you do have a recession, the banks are going to tighten up even more. So I don't want to do deals right now that have 1 year for me to refinance, right? Let me go get a hard money loan. Well, if you're going to get a hard money loan, ask for 2 years or ask for guaranteed, 2 automatic 1-year extensions so that you're not forced to have to refi in a market that potentially could be recessionary, that even though your rates are going to be low, your LTV might be lower, your DSCR might be higher, they might require a higher credit score. And so you don't want to be stuck refinancing in a recession unless you've got, all these contingencies kind of built in. So that's why, like you, I really like the fixed mortgages as much as you can, lock in those rates. And if possible, do it without prepayment penalties as well.
Love it. One question for you, but I know we've been taking a long time, not longer than Zebra's usual videos. So I have seen rental rates go down. Now, I don't usually see that, and I'm seeing that in my market in Memphis. I'm seeing that in Montgomery, Alabama. I have a lot of students that invest there. Houses are staying on the market longer for rentals, right? They're not getting rented as fast, and rental rates are going down in other cities too. Do you think that is any indicator or has anything to do with an impending recession?
I do, with the caveat that real estate, really is very, very local. There's really not a regional real estate market, right? Real estate has so many different asset classes, and then each market is kind of its own different animal. But generally speaking, the more a market went up in both value and rent quickly, the faster those markets are going to come down in both value and rent
Yes.
quickly. And part of the reason for that is oftentimes those were areas that people were moving in. So even though I live in Pennsylvania, I invest heavily in Texas. And so, we've got properties where so many people were moving to Texas and Tennessee as well, Atlanta, Georgia, North Carolina, certain areas where there were so many people that moved there because of the pandemic and being able to work from anywhere, that there was a lot of building. And so those markets are undersupplied, but in certain of those cities and certain asset classes, like let's say an average class C, workforce housing, that now you've got all this new construction in the class A and class B nicer apartment stuff. So there's so much supply in the nicer stuff, and people that are afraid of a recession might move down into a class B apartment or move down to a class C. So now you've got all this new inventory in the higher end rentals. Those are the ones that are really taking a hit first, because people are just saying, I can't afford that like I thought I could, or I can't really work from home like I thought I could. And so in certain markets, it's the higher end, nicer properties that rents are coming down because they're having to compete with each other to be filled because there's so much new inventory.
Yes.
Other markets, like where I am in central Pennsylvania, we are so undersupplied, Casey. We do not have enough housing. I stay, and I kid you not, for 15 years, we've had a 2% vacancy rate, and we've been 100% occupied almost always since COVID.
Awesome.
And so, because we basically don't have enough supply, our rents are not coming down. What we are experiencing, though, is people starting to go month to month just to see if they can find something else. And then they end up coming back and signing with us, or we might have a property sit on the market a little bit longer to rent because people are second guessing that rent. And so, just in full disclosure, we have a property that I just said to my property manager, okay, we haven't had any bites. Let's lower it 25 and see how many more calls we get. And we lowered it a little bit and we started getting a lot more interest. So people definitely have felt the squeeze of, between COVID, they're out of COVID money. They're worried about a recession. And I think that is going to really impact rents and get softening, generally speaking, especially in the higher end markets. And we're already seeing that in some markets as well, for sure.
Awesome. Great answer. Thank you. I was curious to get your opinion on that because I've seen properties stand. I mean, I know it's winter, entering winter, but this is more than normal for winter. So I'm thinking maybe it has something to do with, what you were saying. So awesome.
And I think, this goes back to also, and I hope people don't mind the video again being a little bit longer, but in the craziness of the last couple of years in the real estate market, because we had such low vacancy rates and such high rents, mostly in these areas where people were really moving to quite a bit, more than the supply, people started underwriting those deals as if we're in a new normal, and vacancy rates are always only going to be 2 or 3%, and rents are rents are always going to go up 3 to 5% per year. When I underwrite deals, I wasn't doing that. I'm saying, listen, I've been investing long enough to know that you've got ebbs and flows, and I still underwrite my vacancy rates at 10% on most properties that I do, because the national average has been about 9% over decades. And so for me, if it makes sense with 10% vacant and 2% rent growth and 2% expense growth, or 3% rent growth and 3% expense growth, because usually you can push it to at least keep up with expenses, then anything better than that is gravy on top. But do not be analyzing your deals thinking wherever rents are today, they're going to keep going up and your vacancy rates are going to stay low forever, because that's just not going to happen. They'll normalize over time, but I like to use 10%, because it tells me that as a long-term real estate buy and holder, I know I'm going to go through a few recessions and ups and downs. I always outperform my numbers, but I buy based on really conservative numbers, like a 10% vacancy rate.
Awesome. You are killing it. Oh my gosh. I love talking with you. All right. Any last words? Do you want to wrap up since it's your video?
Great. Thank y'all so much. Just be cautious, be realistic, but also be optimistic. Keep looking at deals. Like Michael always says, do the work, do the work, do the work, because the harder things get, the less competition you have, the more motivated those sellers are. And we might finally have, that glimmer of opportunity, where we do see some motivation as we see pain, and just continue to do deals one rental at a time and grow your wealth, and know that after a recession comes another expansion. So these things go in cycles. Just keep doing the work all the time, kind of dollar cost average your real estate portfolio. And we are here for you, and we'll see you next week.